Welcome, dobrodošli, bienvenue. Welcome to our participants today from Slovenia and from Canada in British Columbia, Quebec, and Ontario. I'm Sonia Rosenworth, the Executive Director of the Canadian-Slovenian Chamber of Commerce, the organizer and host of CSCC Business Insights. We thank our directors, the CSCC members, the Government Office for Slovenians Abroad, Spirit Slovenia, and the Slovenian Embassy in Ottawa for making it possible to create and present these insights from the Slovenian Business Network. Thank you for connecting with us today as we present the first CSCC Business Insights Seminar of 2025. Robert Kavcic is a well-known financial authority on Canadian economic and financial trends, frequently appearing on networks like CBC, CNN, Bloomberg, and Business News Network. Since 2006, Robert has been part of BMO Capital Markets, where he plays a vital role in assessing economic, fiscal, and real estate trends in Canada. He regularly contributes to various departmental publications, serves as a media commentator on economic and financial matters, and provides counsel to Canadian policymakers regarding economic challenges. Prior to his tenure at BMO, Robert was employed in the research department at the Bank of Canada. He earned an honors Bachelor of Arts degree in economics from the University of Western Ontario, followed by a master's degree in economics from Carleton University. We value Robert's partnership with Canadian-Slovenian Chamber of Commerce, which is also linked to his Slovenian heritage. We're honored that he's with us here today to share his insights. Mr. Kavcic, welcome officially to the CSCC Business Insights, and thank you for being our special guest speaker today.
So first of all, just give you a look at just the underlying economic outlook right now in North America. It's actually pretty solid. So about 1.7% growth in Canada this year, 1.9% in 2026. That's pretty normal, sturdy, trend-like economic growth in Canada. A lot of the information that we've been getting the last 3 to 6 months has actually been pretty encouraging. And the reality is that interest rates have fallen quickly. They've fallen quite a bit. And we're starting to see that reflected now in things like housing activity coming back a little bit, auto sales coming back. The job market and hiring activity is actually pretty solid. And then in the US, we have a US economy that's growing at about, let's say, 2.5% to 3%, which is very solid. And that economy, despite still high interest rates, hasn't really slowed down much at all. And usually I would say that the best thing for the Canadian economy is a US economy that's performing well, right? Because we're a small economy, we trade heavily and have deep relationships with that in the US. Unfortunately, that narrative is kind of changing a little bit right now because we're being threatened with action on the trade front. So as I go through this presentation, I'll spend a few minutes on what a trade war might look like, but the underlying economic outlook that we have and that we present assumes that there is no tariff action on Canada until it actually becomes law and is actually put in place. And remember, we went to a couple of weeks ago, we went to the 11th hour with tariffs coming at us. And a lot of economists out there and a lot of policymakers were quickly changing their economic outlook. And then, of course, on that Monday evening, President Trump in the White House come out and says, you know what, we're going to kick this 30 days down the road. So we're in the practice of not adjusting our economic outlook until things change. But if things actually do change, and we can look at a couple of the potential changes coming at us, things like 25% tariffs on steel and aluminum, that's most likely coming at us March 12th, a wide-ranging 25% tariff on all Canadian imports into the US. That was extended to March 4th. I'm going to be really surprised if that actually goes through, just given that from an economic and an inflation perspective, it doesn't make a whole lot of sense to put a widespread tariff on your closest and most direct trading partner, but we'll see. And a little bit of a smaller tariff on energy. So that's kind of the things that we've been threatened with. And then, of course, we've seen Canada's response to that, where Canada has come out and said, look, if we actually see this action, we're going to turn around and retaliate with tariffs on US imports totaling about $155 billion. So stuff like food, consumer products, various manufactured goods coming back into Canada from the US side. So what does this all mean? So take a couple minutes and imagine just what the economy would look like if we actually go into March and have this trade war kind of take shape. So a couple things. There's a growth impact, there's an inflation impact, and an impact on interest rates and the Canadian dollar. So first thing we would say is because Canada is so exposed from a trade perspective to the US, that if we were going to actually get hit with these 25% tariffs, we would go from what has been pretty stable growth, just under 2%, to probably about zero for 2025. So that's effectively a pretty textbook recession for the Canadian economy in the event of a trade war. The response would be from the Bank of Canada would probably be to cut interest rates. Now, the Bank of Canada has been pretty careful with their communication on this because there are a couple moving parts here. One is growth would fall relatively quickly, yes, but at the same time, when Canada's retaliating with tariffs of about $150 billion, that is inflationary for the Canadian economy, at least to some extent. And the Bank of Canada, being a central bank that has to really guard and target against higher inflation, would be a little bit careful to actually communicate lower interest rates. So and my personal opinion on this would be that the growth impact would be pretty significant. The inflation impact would be quite a bit smaller, and therefore they might be a little bit slow to do so, but the Bank of Canada would in fact cut rates more aggressively in that environment. So we would probably assume about 100 basis points of extra Bank of Canada rate cuts in the event of a trade war. And then if you look at the Canadian dollar, when you have a small open economy that is very reliant on trade with a flexible currency, right? The very immediate, probably most direct and most significant financial market response is the currency, right? So if the US goes in and puts 25% tariff on Canadian imports, well, the market can adjust really quickly to that by just depreciating the value of the Canadian dollar. And so in that environment, we would probably see the Canadian dollar pushing up to about 150 on a US dollar basis, and probably very quickly as well. So that's not all priced in right now, but that's where some of the risk would lie in the event of that kind of trade war. When you look across Canada, you start to see some differences as well. So that's just a picture of which provinces are most exposed to US trade. So the total value of those bars would be just the share of exports in each province as a share of the economy that goes to the US. The green bars would be energy. The blue bars would be non-energy. So I kind of break out energy here because energy is a bit of a unique export. One, it's going to be tariffed less, presumably by the US. They are dependent on Canadian energy. And also it's kind of debatable who actually absorbs the impact of tariffs on Canadian energy imports. Presumably the US refiner is going to have to swallow some of that. A lot of it's going to get actually passed on to the US consumer. So it's inflationary in the US. And then maybe the Canadian energy sector absorbs a little bit of it, but the vast majority of it, I think, actually gets absorbed south of the border. And so we don't actually see a huge economic impact from tariffs on Canadian energy. Where we do start to see a bigger impact is in things like autos and manufactured equipment, stuff like steel and aluminum, where we're very dependent on those trade flows. And that would be the blue bars, it would be non-energy exports as a share of the economy. And then you can see from that who is most exposed here. It would be provinces like Ontario with a big auto sector, Quebec, Manitoba with big exposure to things like aluminum, aircraft, pharmaceuticals, other manufactured goods, things like that. So the impact starts to become pretty disproportional in a trade war, depending on where you are in Canada. You could very well see a province like Alberta or Saskatchewan not really notice this much at all. Whereas you have a province like Ontario or Quebec pretty quickly fall into something that looks like recession just because those kind of gears of economic trade have really had a lot of sand thrown on them and they really start to slow down. So again, just to highlight here that I always talk about the Canadian economy and the impact from a trade war. Well, again, a lot of it depends on where you are in the country, and central Canada would be certainly most exposed. Okay, so that's kind of like the risk that we're looking at, and hopefully over the next couple of weeks we'll get more clarity on this, and hopefully we don't actually go down this road. But in the event that we do, you have a little bit of context now for maybe what the economic impact might start to look like. So back to the regularly scheduled programming, the economy as it is right now, and how we expect it to evolve if we can just kind of avoid a lot of this trade risk. Take a look at the job market. The job market is actually performing quite well. We're seeing still pretty steady rates of job growth in Canada, which is great news. And job growth has actually picked up a little bit in the latter stages of 2024. So again, the economy just reacting to lower interest rates. What you're looking at here is an actually increasing unemployment rate in Canada, which ordinarily would be a little bit of a concern when you see the unemployment rate rise like a percentage point and a half off the lows. The reason this time is a little bit different, and the reason the jobless rate has been pushing higher is not because of job loss. It's been because of just a lot of labor supply pouring into Canada, right? And so when we've had a immigration program that's been running at about 1.3 million people per year. It's been about 3% population growth. Canada's been creating jobs. We just haven't been creating jobs fast enough to absorb that influx of labor supply. Right? And I point this out because as we speak, policymakers have really turned down the taps on population growth and immigration. So a big change that we're going to see in 2025 and 2026 is going to be that population growth actually slows down pretty dramatically. And so that's what it looks like from a demographic perspective. So that's just kind of a breakdown of where population growth in Canada has come from. We've historically, go back the last 10 or 15 years, we've seen about 1% population growth. That was about normal. It was very sustainable from a longer term perspective when we think about things like housing creation and things like that. 2022, 2023, and into 2024, we saw population growth really explode. So I mentioned 3% population growth. It's about 1.3 million people per year. You can see the breakdown of where that population growth has come from. So the green bars are permanent resident immigration in Canada, which is, call it like the type of immigration that you and I would ordinarily be used to thinking about or talking about. So skilled workers coming into Canada, hired by a company, given a pathway to permanent residency, things like that. Historically, that's been about 250, 300,000 people per year. The orange bars are births. So Canada just doesn't have a lot of babies, unfortunately. I'm doing my part for the record. I've got 3. So I'm well above replacement, but I get it. Affordability is tough. Women are working earlier. They're taking on higher roles. The birth rate is down. Okay, that's common across Europe. It's common across the United States. It's also evident in Canada too. We just don't have a lot of babies. And then the blue bars are what we're calling non-permanent residents. So that would be international students and temporary foreign workers. And that you can see pretty clearly is what has really changed the last couple of years, where there's been a dramatic influx of international students as a pathway to eventually get permanent residency. And there's been a dramatic influx in temporary foreign workers. So Canada usually leans on temporary foreign workers in a few areas where we just can't get enough labor supply, like seasonal industries like agriculture and things like that, certain pockets of the energy sector, the manufacturing industry. But the use of temporary foreign workers has really exploded well beyond that. And that was one area of the immigration system that had no checks and balances in place. And now policymakers looked at this and said, you know what, this is getting a little bit out of hand and it's too much for us to handle on the supply side. Think about the stress on infrastructure, ability to find healthcare, the ability to find a place to rent, things like that has all been really stressed. And so policymakers have finally come in and put a cap on this. What this means is as we go out to 25, 2026, 2027, we're going to really see population growth slow down to probably about 0 for the next couple of years as we adjust to what we've seen over the last 3 or 4 years. And then eventually we settle back into around 1% population growth in Canada. So that's a big adjustment. And I'll talk about real estate in a minute, but one big area where we're seeing this have an impact right away is on rent. And we have a lot of rental supply coming to the market right at the same time when population growth is completely flattening out. And all of a sudden, in a lot of the big cities in Canada, you're seeing rents start to fall, which we haven't seen in a number of years. And this is very early stages of this. We have a couple of years to go still. When you look at the other aspect of demographics, what's kind of interesting here is that Canada is, not only seeing a lot of people come into the country, but moving from province to province. And so that's just a quick look at where existing Canadians are moving to right now. And effectively, if you look at that chart, they're moving to Alberta from literally everywhere else in Canada on a net basis. So Alberta is sucking in about 40,000 people per year right now. Ontario is losing about 30,000 people per year. And it's kind of fascinating because like ordinarily you would see Canadians move to either take a higher paying job or to find a job if they didn't have one. Say you were in a really high unemployment rate jurisdiction like Atlantic Canada, and the Alberta economy was really firing and paying a lot to go work in the energy sector. You would see people move for that. But right now, the labor market conditions in Canada are actually very balanced from BC and Alberta all the way to Atlantic Canada. People are moving now to pretty much just find a place to live or to find a backyard. And in Alberta, what we're seeing anecdotally is look at where the people are coming from. A lot of them coming from Ontario. And in a lot of cases, you can see a young family sell out of Ontario, take like $1 million of equity with them, and go buy a single attached house outside of Calgary with a big backyard and a couple $100,000 of equity in their pocket. And a lot of people are making that trade. Well, 40,000 people every year are making that trade right now. So I'll come back to this in a minute when we talk about real estate, but this kind of flow of people is starting to shape the relative performance of different real estate markets in Canada right now. A couple other things. So look at inflation, and then we'll look at what it means for interest rates, and then we'll go through a couple of different areas of the financial markets. So give you some things to take away from all this. So the good news on the inflation front is that we are pretty much back to 2% in Canada. So the blue line there is how Canadian inflation has evolved over time through the pandemic shock. And then as interest rates rose, inflation came down. I'm not going to go through all the different components of this. The big takeaway is that we're pretty much back to around 2%. So that's great for the Bank of Canada. A lot of the easy work on inflation was done pretty early on. So think about things like the demand for consumer goods, right? When we went through lockdowns in Canada, the US, and Europe, what did everybody do? Everybody went out and bought TVs and exercise bikes, renovated their backyards, right? They all unfortunately did that at the same time, drove a lot of inflation for consumer goods. And that very quickly disappeared when the economy opened back up. We've seen things like supply chains ease because of that. We've seen oil prices stabilize, agriculture stabilize, housing is stabilized, rents, as I mentioned, are starting to come down. There's still a little bit of inflation out there in services. And where we're still kind of stuck, and I'll say stuck, it's not necessarily a good thing or a bad thing, but is in wages and just inflationary psychology. And I'll mention wages. I'll give you one anecdote on this. So as I mentioned, I have 3 kids, and any good Slovenian father, I pay them to work and I encourage them to work. And so I get them to do just, random stuff around the house, wash the truck, cut the grass, all that kind of stuff. And they come to me a couple months ago and say, "Dad, you got to pay us more." And first response is get lost. I'm not paying you more. Then they say, "No, Dad, inflation's been like 8%. The real value of what you pay us is falling." So in Canada, we have these, for example, Tim Hortons hockey cards. Kids love these things, right? They come to me and say, "They're $3 this year. Last year, they were $2. You got to pay us more." So I'm thinking, fine, this is a fair argument. I'll give you a little bit of a raise on your whatever, your hourly salary. But then I'm thinking, you know what? This is something that the psychology of this inflation and pressure on wages has rooted so deeply in the economy that even kids in like middle school are talking about it right now. This is a real thing out there in the Canadian economy more broadly. So wages are rising, and the tricky thing with wages is they move pretty slowly, right? So when the economy sees a run of inflation, even though inflation is back down to 2% now, the reality is that it's been kind of psychologically embedded in a lot of people. And a lot of people that would have been put on contracts, say back in like 2018, 2019, early in the pandemic, 2020, a lot of those contracts that are rolling off now are rolling off in an environment where we've had 6 or 8% inflation for a couple of years. So a lot of those workers want to get compensated for that decline in real wages that they saw during that pandemic period, right? So inflation is down, but wages are still pushing higher at 4, 5, 6%, depending where you are in the Canadian economy. And so this isn't necessarily bad news. It's good news in the sense that consumers and households are starting to see positive real wage growth again after adjusting for inflation. But for someone like the Bank of Canada, it's causing them to kind of keep rates a little bit higher because they're aware that that wage growth is strong, and they're aware that that psychology of inflation is still embedded out there in the market, right? So keep that in mind, and you can see what our interest rate outlook is with this backdrop. So in the US, we have an economy that's growing really strong, call it 3%. We have inflation that's running a little bit hotter than Canada. We actually think the bank or the Federal Reserve is going to be on hold with interest rates for a while, probably right through the summer. And we could see about 50 basis points of easing late in 2025 from the Fed, and then a little more through 2026. But focus on Canada for a minute. And Canada is in a pretty good spot in the sense that inflation is right around their 2% target. They are seeing still pretty steady labor market and wage growth, as we talked about. The economy is growing around where they want it to grow, just under 2%. And so from their perspective, interest rates are pretty close to neutral right now. And so we do think they're going to be on hold for a little while as well. And we probably are going to see about 50 basis points more of easing from the Bank of Canada, but it's also going to probably come in the latter stages of 2025. And then that's about it. So two big takeaways I would give you here, like with that economic context in mind, two big takeaways for the interest rate forecast would be that we're very close to the end for the Bank of Canada. Probably another 2 rate cuts through the course of 2025. That's one. And the other big takeaway would be look at where rates are now versus the last 10 or 15 years. They're settling in at a much higher level, right? And this is a story we've been telling for a number of years now, that the neutral level of interest rates is just higher than it was in the past. So if you're sitting there waiting for mortgage rates to go back down to 1.5%, you'll probably be disappointed, right? 3.75, 4%, 4.25%. The rates that we're seeing right now are pretty reflective of what's going to be normal for borrowing costs in Canada going forward. Now, the cycle will always go up and down. We might go a little lower, we might go a little bit higher, but this is around neutral for borrowing costs in Canada, and pretty similar for the US as well. And so a lot of factors that are kind of guiding this. Demographics have changed. This, the US kind of shutting itself down and onshoring production is kind of inflationary. The shift to clean energy is kind of inflationary. There are some technical factors out there, like the Federal Reserve was actively suppressing interest rates between 2010 and 2019 by buying treasuries. Now they're doing the opposite. They're selling treasuries. So there's some fundamental factors, demographic factors, just geopolitical factors, and just technical central bank factors that are all keeping interest rates at this higher neutral level. So that's what I would say on rates. Two big things: a few more rate cuts coming later this year, but get used to borrowing costs around these levels as being normal going forward when you're doing things like planning your mortgage or planning to save in GICs or whatever the case may be. Okay, so that's the rate outlook. I'll spend a few minutes on a couple other areas of the financial market. So again, so you have something to actually take away from this, and then save some time for questions. So I'll cover housing, cover the currency, and cover the stock market very quickly. So housing is a kind of an interesting story in Canada right now. It's at the national level, it's really not doing anything. Sales are pretty flat, house prices pretty flat. construction activity is down and pretty flat. Our view on this has been, so we called that correction very early. We called the bottom probably right about when it came. And so personal view here would be that this market is just going to go sideways for a long time, a number of years. And it gets a little bit more interesting when you go below the surface. So that's just a look at how house prices have behaved in three big markets. So look at Calgary, look at Vancouver and Ontario. We mentioned a lot of people moving into Alberta. Prices are still relatively cheap. Valuations are fine there. House prices in a market like Calgary are actually still pushing higher. Similar for Quebec, similar for Atlantic Canada. Vancouver is pretty stable. And Ontario and parts of Toronto are really the areas where we're seeing most of the struggle in residential real estate right now. A couple things to point out here. So one, where you are in Canada obviously matters quite a bit. The type of a housing matters a lot too. So when you drill into Ontario, when you drill into Toronto specifically, there's a pretty big disconnect between what's happening in single detached housing, which is still very solid and very well bid, and the condo market, especially the smaller condo market, where there is a record number of units coming to completion. And a lot of that supply is held by investors who would have bought something pre-construction, at the height of 2021, 2022. They had the intention to flip that product, assign it, or flip it on completion. Well, because the market has kind of fallen off, that trade is now gone, unless that person's going to take a big equity loss. So what are they going to do as a next step? Well, flip it onto the rental market. Well, what's happening now? We talked about population growth really falling off. And so you have this combination of two factors coming down the pipeline at the same time. A lot of rental supply, investor owned, coming to the market right as population growth is falling off. Rents are starting to come down. And so that's going to continue through 2025 and 2026. So the investment calculus doesn't make a whole lot of sense because cap rates in Canadian real estate, and especially in a market like Toronto or Southern Ontario, are still relatively low versus something like your borrowing costs, your alternatives like a risk-free GOCs or dividend stocks. And somebody would maybe be compelled to take on a property that was cash flow negative in 2021 when prices were rising 10 or 20% per year. Like, who cares if I'm negative for a few months? I'll just flip this thing for 20% more next year. Well, that trade is gone. So all of a sudden, cash flow matters again, but the cash flow mechanics don't work at current valuations. So the investment side of the market is just completely dried up. And until one of two or three things happens, that the investment market and the case for investment in Toronto and Ontario real estate is not going to be there. We need rates to fall further, which we suspect they will, but not that much further. We need rents to rise to bring cap rates up. Well, that's not happening. They're actually falling. Or we need prices to gradually drift down a little bit more. And that's probably the environment that we're in. So we have a few markets that are still pretty firm. We have a few markets that are stable. And then we have a few markets like Toronto condos where I suspect there's still downward pressure on prices. When you zoom out and look at where we are, it's not uncommon to go through multi-year periods where house prices don't go anywhere. I know that sounds weird to a lot of people after the environment we were in, but we're in the middle of a multi-year period where house prices don't go anywhere. And it's going to be probably a number of years still before we get back to those 2022 highs for house prices in some parts of Canada. Okay. I'm sure there are questions on real estate. We can come back to this, but in the interest of time, that's the high level view on that. For the Canadian dollar, so there's two-sided risk on the Canadian dollar, put it that way. So our forecast here has the loonie strengthening pretty gradually through 2025 and 2026. And the reason it does that is, as I said earlier, we don't explicitly put any tariffs or trade war action in our economic outlook. So in a world where the tariff threats and the trade war threats just go away, there is a little bit of a risk premium in the Canadian dollar that's eventually going to get priced out. Again, in the event of a trade war, that calculus changes very quickly. So I would say, I would say this. So if the Canadian dollar is about, let's say, 142, 143-ish right now, uh, if we were to wake up tomorrow and President Trump comes out and spams Twitter saying Canada's amazing, all tariff threats are off, we're back to business as usual, I think you very quickly go to something like 138 on the Canadian dollar. That would be about where interest rate fundamentals would peg the currency right now. On the other hand, if we go into next week and President Trump comes out and says 25% tariffs across the board, boom, there it is. Well, very quickly we go to 150 on the Canadian dollar. Okay, so that's kind of like the two outcomes here. And the market right now is saying implicitly there's a little bit of a chance we go into a trade war, but we're not fully pricing it in. Those would be about the two levels I would look at for the currency, depending on how things evolve over the next couple of weeks and the next couple of months. And unfortunately, I know that's not a very definitive outlook, but that is the reality of the environment we're in. We're going to probably end up going in one of those two directions. And then finally, for the equity market, I mean, we're pretty positive on stocks. We've been pretty bullish on equities for some time. You can see the current cycle kind of mapped against some of the bigger cycles that we've seen in the last 20 or 30 years. And I mean, we're pretty much right on pace with some of the bull markets we've seen in the past. For equities, I mean, so we've actually come out of a very, very favorable period. Probably the most favorable economic environment for the stock market is a period where growth is pretty resilient and you're seeing disinflation from high levels. So coming out of COVID, for example, disinflation is positive for equities. It's allowed central banks to cut interest rates. It's allowed the economy to hold firm. That is really the best part of the cycle. We've kind of pushed through most of that, but we're still left with a US economy that's growing at 3%. Earnings growth is very solid. US equity valuations, I would say, are a little bit expensive. Canadian valuations are actually very cheap. So if you look at stuff like Canadian dividend stocks, even if it's like banks, telcos, the energy sector, relative to the US, Canada is actually still very cheap. So our strategy team is still pretty bullish on both the US and Canada, and especially Canada. If we can avoid a trade war, Canada actually comes out of this looking pretty good. So we don't really see a compelling reason to stress about stocks. Obviously, a full-scale trade war is kind of the opposite of rate cuts and disinflation. A trade war is negative for growth and it's positive for inflation, which is not a great combination for the equity market. But right now, the equity market is looking at this and saying, you know what, this is probably a lot more bluster and threats and negotiating tools than it is actually going to be permanent changes in trade policy. And if that's the case, then we're still in a pretty good spot for the stock market for some time. Okay, so I will leave you with that. If there's one thing you want to just kind of take home with you or a screenshot or whatever, this is probably it. It's my kind of quick way of taking everything I talked about for the last 30 minutes and just cramming it into one slide. So growth is stable. Inflation is around 2% in Canada. Great. Interest rates are about neutral, maybe going a touch lower from here. Stock market is still solid. The real estate market, again, is pretty neutral. It depends on where you are. Calgary, great. Single detached housing, fine. Toronto condos, not so good. And the Canadian dollar is weak. And unfortunately, just given the risk out there from a trade policy perspective, it's probably not going to be in a great spot for some time. Okay, I'll leave it at that. And if there are any questions, of course, happy to take those.
Thank you, Robert. I'm going to open up the gallery. Please use the raise hand button in the bottom of your screen there if you have a question that you'd like to ask. I'll guess that Randy, maybe you still have questions from your list. You're on mute, Randy.
Can you hear me now? Hi.
Yes. Thank you.
Sorry about that. I'm in someone's office and they're trying to kick me out of here. I apologize.
Oh,
I
dear.
will get to my questions right now. Okay, yes. So I guess as an investor and in real estate, as a property manager, and I don't know if I speak for everyone, well, hopefully I will. I think we're all scared and nervous. What's going to happen? I do have some questions that I'd like to get answered. And the first one is, with Donald Trump returning to the U.S. presidency and potentially imposing tariffs on trade, what are the implications for the Canadian economy? How might key industries be affected? The automotive, aluminum, steel, and all that.
Yeah, sure. So we touched on the big picture of that early on, right? So we would probably be looking at in a province like Ontario, Quebec, where we have a lot of trade exposure, we'd be looking at something that looks like or resembles or feels like a recession in a few of those industries for sure.
Okay.
Something like the auto sector, for an example, right? We've spoken to the auto industry and they've said, like, look, we can't operate in a world where we have 25% tariffs, right? Because you have the trade is so integrated. You have things like components moving back and forth across the border 5 or 6 times before a car is completed and rolls off the assembly line. They can't operate like that. So in some of those cases, they would just have production shut in. And look, then they've told the White House this, and I'd be surprised if it actually goes through as written because of this. But I mean, if we're going to take what was put in that executive order a couple of weeks ago at face value, then yeah, there are going to be parts of Canada that are feeling like we're in recession. It won't be everybody, as we talked about. It won't be every industry, but there will be some.
Okay. So do you think we're heading into a recession? And what key risks and signs to watch for in the next couple months? If
No, I don't.
Okay.
I think we are actually, believe it or not, we're we were actually in a position where we were almost from a contrarian perspective, getting pretty positive on the Canadian economy coming into
Okay. Yeah.
2025. Yeah. Yeah. So if we get a trade war, full scale trade war, like the president has threatened, then the calculus changes. And yeah, we're at risk of recession. I don't think we're going to get that. And if we don't, no, I don't think we're going in recession. So the problem with all of this is that even if we don't get tariffs or a full on trade war, the fact that everybody is talking about this and thinking about it and worried about it right now is already kind of putting off some investment plans and putting off some hiring plans. So the economy is going to run a little bit cooler than it was coming into 2025 just because of the threat, right? But that's not enough to put us in recession.
Okay. All right. I have another question. How will the real estate and rental markets be impacted by the economic uncertainty? Like, for example, I want to list my house in Etobicoke Center, and there's no movement on the other houses that are on the market. Houses that are marking up for 60 days, with this rising interest rates and potential policy changes. How is that going to affect the real estate and rental markets, because people are I guess afraid, right?
Yeah, there's that. I think the reality is we talked about this in the presentation. The reality is that prices are still, unfortunately, they're off 20% or so from the high, but they're just not off enough to account for where borrowing costs and where incomes are right now, right? So I mentioned some of the problems facing an investor. The investor market is dried up because it doesn't make any sense at this point. That's not going to change. It's not going to change, especially with rents now falling as we put population caps in.
Yeah. Yeah.
And then just from an affordability or from like a household affordability perspective, forget about investors for a minute. Prices fell by 20%, but we're still in an environment where borrowing costs are a couple hundred basis points higher than they would have been 2, 3, or 4 years ago, right? So from an affordability perspective, prices are down, but the affordability yet isn't back yet to where it was in a more normal environment. So you can fix this, as I said earlier, you can fix this a couple ways. Interest rates can come down more, and that would probably put a floor under the market, but they're not. We're probably around this level for some time. Or prices fall further. And if the market's going to start clearing, let's be honest, in a lot of these markets, like Southern Ontario, prices are just going to have to fall further if the market wants to clear. Or what probably ends up happening if there's no recession, you have prices really go nowhere for a number of years. Activity is pretty slow, and incomes gradually rise to bring affordability back, but it's a really slow kind of grinding process.
Okay.
So the short answer is it's going to be pretty tough for real estate for a little while still.
I understand. Okay. My last question. As a country, are we adequately prepared for the potential economic downturn? Are we ready for this?
Well, it depends what it looks like, right? So if we're in an environment where we have a full-on trade battle with our closest trading partner, there are a lot of areas where we're not prepared, right? We don't have a lot of diversity in terms of where our exports can go, right? We're a very resource and export oriented economy. Unfortunately, 80% of that goes south to the United States. And the last 10 or 15 years, when we had an opportunity to diversify our export channels, we've pushed back and have not done that. So stuff like, pipelines to the West Coast or across Canada, like things like that, right? So in that sense, we're kind of trapped. But I would say where we are in a pretty good spot is, let's say, from a fiscal position, right? So one thing we're hearing about now is if we end up in a tough economic environment, you're going to see provinces and you're going to see the federal government step in and support the economy. And from a fiscal perspective, we actually are in a pretty good spot. So we're still running deficits across most provinces and the federal government, but those deficits are relatively small. They're tiny compared to what we're seeing in the United States. And so if we were to wake up next week and have to push a lot of fiscal stimulus onto the economy, right, be it like tax relief or support for different industries, we have the ability to do that. We have fiscal capacity to do that.
Thank you.
Are there any other questions from anyone or comments? Oh, yes, Andrew from Moya Financial Credit Union, the CEO. Go ahead.
Hello, you guys hear me?
Yes, we can hear you.
Sorry. Yeah, so thanks for this, Rob. This has been extremely insightful. I've been on about 3-4 of these calls in the last week as our regulator is starting to provide pressure on us, FSRA, as to what our plan is in this environment, and kind of kicked off about 3 weeks ago when we were about to sign off our financial statements, and the auditor at the 11th hour says, "So, what are your thoughts on ratcheting up that loan loss provision?" I said, "No." But anyways, sorry, I should have told Irene to kind of block her ears on that one. But I guess the Q1 earnings for you guys, BMO as well as Bank of Nova Scotia, came out earlier this week, and I read that both banks have put aside about $1 billion additional loan loss provision. Now, is that an earnings play, or is that pricing in potential tariffs? Just trying to look at the trend and kind of like how we at Moya should be kind of focusing on that number as well.
Yeah. So full disclosure, I'm not really a bank analyst, and I'm not really usually at liberty to talk too much about earnings and stuff like that. I would say from our perspective, it's not reflecting tariff risk. We've revised down our growth outlook a little bit to account for the fact that businesses are going to hold back investment and hiring, regardless of if we get a trade war. But we haven't explicitly built in any kind of risk of a trade war yet into our outlook, and probably not. Again, I don't want to comment too much, but probably not in those loan loss provisions. In a lot of cases, that those numbers that really were ratcheted up through 2024, especially into like Q3, Q4, were reflecting a lot of the commercial real estate conditions in the United States, especially for a bank like BMO that has a big U.S. footprint. And those, from as far as I can tell, have more or less peaked, or the bar was set high enough, or the bar was set low enough, I guess, for us to now step over going forward.
Yeah, and I'm just trying to think, we're obviously in the credit union space, and we would never want to see anyone lose their houses, but if it becomes a systemic issue, the question is, what are your levers to do? What levers do you have to avoid enforceability, right? Whether it's forbearance clauses, deferrals, waiving, what have you. We've never been, in a situation, I guess, like this before with the potential tariffs coming down the pipeline. But, is there, do the big banks take that approach where there is a systemic, issue and, they work with their clients to kind of come up with solutions, or, do they nail the book down them and start kind of like the power of sale process?
No, so this is one area where I would say the fear and the noise has been a lot worse than the reality, right? And in a lot of cases, so we're going through this wave of mortgage renewals right now, as you know, right? Peaking out 2025, 2026. So a lot of those 1.5% mortgage rates are rolling into about, let's say, 4% or so. In a lot of cases, what we're seeing now is rates have fallen enough for that to be manageable. If we were rolling into 6.5%, like we were worried about 12 months ago, that would be a problem. But rolling into 4 is a lot more manageable. I've had 5 years of income growth, real income growth, all that's helping. The job market's stable. And in a lot of cases, the banks, what they are doing is if there is a problem, they're kind of renegotiating and doing stuff like extending out amortization and things like that on renewal, just to kind of ease the monthly payment burden, right? The last thing the banks want to do is go through the foreclosure process. Right. So we're not seeing much of that. Like the delinquency rate numbers were out yesterday too. They're off the lows, but we're still at like, even in Ontario, like 0.2, 0.3%.
Rob, do your outlooks or the market's outlook, like you said, factor in the 2020 loans that were put on at 2%, now they're being renewed in the 4s, which arguably is doubling your debt service, and as a result, people have less discretionary money to spend, go on vacations, go to restaurants and whatnot. Full disclosure, because I tell our membership every year, but 67% of our loans were put on in 2020, 2021 at an average 0.1%. So we got completely slaughtered the last couple of years. Yes, we had some interest rate swaps to help, but nowhere near to avoid the pain that we saw. But I would imagine our balance sheet is probably one of the worst, but not that far off compared to other FIs. But kind of curious to know that if that has been factored into outlooks and whatnot.
Yeah, like I can't comment much on our exposure. I think it's not wildly different because we all went through the same conditions together, right? And you look at the Bank of Canada's numbers, like about 30 or 40% or something like that of outstanding mortgage debt in Canada was taken in that low rate period in 2021, right? So you're not alone, right? Proportionally, there's a huge chunk there. But for our outlook, what we're doing here is exactly what you said. We don't think there's going to be a systemic like delinquency or foreclosure problem because of all those factors we talked about already, but you still have to make the higher payment as a household. So discretionary spending does slow down. Restaurants, travels, exactly what you said is what we have assumed. And even though real incomes are rising, we have a pretty slow run rate for real consumer spending in Canada because of that. They still have to make those payments.
And last question, sorry guys. And I'm sure I could go around the room and ask this question to everyone. Everyone would have a different opinion, but you had mentioned that odds are this is just a ploy for something bigger for the Trump administration. Obviously it threatened, the tariffs with the whole, border security as well as, both on immigration as well as the fentanyl trafficking. But now he's clearly going after, Canada being the 51st state, but in reality, probably going for our minerals. Where do you see this going, Rob? Like, is this again going to be another tease of, oh, you know what, I'm going to extend it another month, and the panic goes away for another month, and as of yesterday, he was tweeting out that he wants the Keystone XL pipeline back in circulation, which the Biden administration kind of cut. So clearly all over the map and totally sending the interesting signals, knowing that pipeline would be used to transport our quote unquote dirty crude oil from Alberta down to the Midwest. So what is your take on this? And I'm sure I could ask your dad the same question and you might have a different answer, but I'm just kind of putting you on the spot here.
we've almost got to the point where we hit the mute button until something changes, right? Because you said it exactly. Last week it was we don't need Canadian oil. We're going to drill in the US. And this week is we want Keystone XL. Well, Keystone XL brings heavy crude to the Gulf Coast. It's Canadian oil. So like, which one is it, right? So it's you know what? It's hard to say. Uh, and hence why, like in our outlook and the outlook that goes into the bank's forecasting is we have scenarios on either side of it, but it's to the point now where it's like we're going to react when something actually changes. And as of today, nothing has really changed on the tariff front. We'll see again next week, and we'll see again the week after that. Where we end up, I mean, to actually answer your question, I don't know. This is probably the most logical take would be that this is probably just like pre-negotiating a new USMCA in 2026 and maybe bringing that further. And we'll probably have to push some concessions into that, whether it's something like dairy or something else on the trade front. I don't know, but I think that's ultimately where it goes. I don't know. Other than that, it's just like pure speculation. That's not kind of what I want to do.
Rob, thank you so much.
Okay.
Thank you, Andrew. Anyone else have any more questions? No? Edward?
I'm good. There was a great presentation, Robert.
Okay, thank you. I think if anybody has any comments, I'll let you speak now, or I'm going to go close the meeting. Okay, well, thank you. Thank you, everybody. Thank you, Robert, for your candid insights, and of course, for being a valued associate of the Canadian-Slovenian Chamber of Commerce, and of course, the Slovenian community. We're pleased that you agreed to join us today and to share all your insights. It is a nervous time for people, and I think being candid and giving us the real information and the honest outlook is very much needed right now. It's the mission of the Chamber to strengthen the Slovenian presence on the global stage. We're here to support, connect, and collaborate to encourage bilateral commerce between Slovenia and Canada, but also between Slovenians within Canada. As mentioned, please contact us for more information at info@canslo.com. Please keep in touch. Thank you, Robert, Kavcic, and thank you, viewers, for joining us at Business Insights presented by the Canadian-Slovenian Chamber of Commerce. A video of this meeting will soon be available on the Canslo YouTube channel, and I'll email you the link after I edit, and we'll send you when it's posted. So lepo se imejte in upam, da se kmalu spet srečamo. So actually, I think almost everybody could understand me if I spoke that properly. I hope you'll join us again soon. For now, nasvidenje and lep pozdrav.
Nasvidenje.
Nasvidenje. Bye-bye.
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 Bye.
Zdravo, hvala.